Good evening and welcome to Market Pulse Weekly, where we make sense of the chaos in the business world because someone has to, right? Whether you're trying to strike gold with your next investment or just hoping your retirement plan survives the week, we've got you covered. Tonight we will break down the numbers, crunch the data, and who knows, maybe even predict the next market meltdown because in today's economy, the only thing more unpredictable than your portfolio is your boss's mood on a Monday. So sit back, relax, and let's talk money, because if you're not laughing about it, you're probably crying. Tesla has officially gotten the green light to expand its highly controversial factory in Germany, the US-based electric car giant, to ramp up production to 1 million cars annually, surpassing even Volkswagen's main plant in Wolfsburg. Ambitious, right? Especially since Tesla hasn't even hit the 500,000 mark it initially promised. But hey, when has overpromising ever been a problem for them? That's right, because who needs to hit the target when you can just keep setting bigger ones? The expansion at Grünheide would make it the largest car-making plant in Germany. There is just one small hiccup. Demand for EVs in Europe is currently falling. So when Tesla actually needs all this extra production? Great question. Maybe they will get back to us once Elon finishes building his Mars colony. Remember how the zero-emission, eco-friendly car maker cleared 500,000 trees to make space for its green factory? Yes, you heard that right. Cutting down forests to build a factory that runs on renewable energy makes total sense, doesn't it? It's classic Tesla. Really saving the planet one bulldozed forest at a time. But no worries, the company says it's all part of their sustainable mission. You know, the same mission that's always under just a little bit of scrutiny. Because what's sustainability without a bit of hypocrisy, right? BMW's chief Oliver Zipse, hopefully I nailed the pronunciation, has called for a read on Europe's proposed petrol engine ban by 2035, citing concerns over dependency on China. Well, it's nice to know that even the powerful BMW group is starting to worry about who will be holding the EV battery monopoly in a decade or so. Yes, because nothing says let's save the environment like clinging to combustion engines for a little longer, right? Zipse warns that the 2035 deadline might be a bit too ambitious and could make Europe overly reliant on China for EV batteries. So basically, the choice is between keeping petrol cars or letting China run the EV show. Decision. Several EU countries like Italy and Czech Republic have also voiced concerns about the deadline, pushing for more flexibility. After all, why rush into clean energy when we can just sit back and debate for a few more years? Meanwhile, Germany's Social Democratic Party has thrown out the idea of scrubber scheme to help the EV transition, but industry groups think better charging infrastructure would do the trick. The classic scrap your car or wait for a charge debate. Nothing more forward-thinking than that. Well, Boeing is back in the headline. This time, it's looking to raise a cool $25 billion over the next 3 years. Because when you are facing strikes, production issues, and a 42% drop in stock price, what better way to shore up your balance sheet than by opening the debt and equity floodgate? That's right, Boeing has put in place a universal shelf registration, which basically gives them a few options, shares or debt, to raise the cash they need. Bank of America analysts are predicting they will raise between 10 to 15 billion in equity. Fitch Ratings seems to agree, calling this move a smart play for Boeing to keep some near-term liquidity issues at bay. Boeing's credit rating has been hanging on by a thread, and it gets better. Boeing's got a $10 billion credit agreement lined up with a group of banks, but don't worry, they have not had to dip into that just yet, at least not for now, as the company plans to slash around 17,000 jobs, because when you're in a crisis mode, why not start by cutting 10% of your workforce? Classic move. Absolutely. And we can all look forward to Boeing's new CEO, Ortberg's first quarterly investors call on October 23rd. I'm sure he will have all the answers to calm investors' nerves as they stare at those $5 billion in charge and mounting losses. You've got to love the corporate optimism. Amazon has just added a splash of color to its Kindle lineup with the launch of the Kindle Color Swap, allowing readers to quite literally judge books by their covers. This new device is essentially a Kindle Paperwhite but with the addition of full-color displays, Spectrum 4 in-book images, and when browsing, highlighting text in multiple colors like yellow, orange, blue, or pink. Priced at $280, the Color Swap starts shipping on October 30, marking significant shifts for e-ink technology. Looks like Amazon is stepping up its game as a competitor like Remarkable have reason to worry. Big Tech has just set its sights on nuclear energy as the powerhouse for the future artificial intelligence, despite the shadow cast by past nuclear disasters that have sparked debates about safety. Silicon Valley is boldly stepping into a new era of nuclear power to fuel the relentless demand for AI. Just in the last month, Microsoft has revived a reactor at the famous 3 Mile Island, while Google has secured a deal to purchase energy from small modular nuclear reactors. Now Amazon has just joined the fray, announcing a $500 million investment in nuclear reactor in partnership with Virginia's Dominion Energy. This new facility will supplement existing nuclear power stations. The drive for AI isn't just about innovation. It's also incredibly energy intensive. The data centers that process machine learning require massive power inputs, for exceeding what solar or wind can offer. But why bother with a stringent green policies when AI is clearly the future? Who needs eco-friendly solution when we can just simply rely on robots to save the day? This trend aligns perfectly with big tech's ambition to boost their market caps while addressing their often ambitious clean energy goals. Google recently acknowledged its AI advancements increased in corporate emission by 13% last year, making it harder to meet its carbon target. However, it's not just tech giants advocating for nuclear power. Many scientists believe it to be a reliable green energy source as countries transition away from fossil fuel. According to a study, a majority of Americans are supportive of nuclear energy. Startups like Oklo and NuScale Power Corp are reaping the benefits, so too do the prospects for tech stocks, provided those investments yield positive results. With nuclear power on the rise, these stocks could potentially see even greater gains in the future. Looking at venture capital in China, and the numbers are, well, failing. VC funding in China dropped 12.6% to $23.3 billion from January to August 2024. That's from 1,761 deals, down 18.5% in volume compared to the same period last year, according to global data. So fewer deals and less money. Sounds like a recipe for success. Now, while China remains the second largest VC market globally, other nations like US, UK, and India are seeing growth in their funding. India in particular posted a whopping 53.1% increase. China's large deals, those $100 million plus investments, dropped from 58 to just 43.
Ouch!
Looks like China is taking a less is more approach, though in this case, less isn't exactly more, is it? Starbucks, your beloved overpriced caffeine fix. But these days, it's less about sipping your caramel macchiato and more about gulping down some bitter reality. The company is in some serious hot water, literally. New CEO Brian Niccol, who recently jumped over to fix the coffee giant, seems to be facing more challenges than just crafting the perfect latte art. So what's brewing over at Starbucks? Well, in their latest quarterly earnings report, same-store sales dropped again, down 7% globally, with North America down 6% and China, oh boy, 14% in the red. It's like they are competing with their coffee prices to see which number can fall faster. The result, shares took a hit, sliding 5.5% before barely recovering, just enough to keep the light on and the frappuccino flowing. Nicole, the new guy in charge, says he's got a plan, a grand plan. And what is this master stroke? Simply the overly complex menu, weak pricing, and fixed bottlenecks at store. Oh, and let's not forget his genius insight that morning orders could be faster if store were better staffed. Groundbreaking stuff, right? Meanwhile, on the other side of the world, in China, Starbucks' second largest market, things aren't looking too beautiful either. Turns out local Chinese chains are outpacing Starbucks faster than you can say mocha frappuccino. And Nicolo's expansion dreams over there are falling flat. Who knew the competition could brew their own success? Now let's address the espresso elephant in the room. Starbucks might be facing more than just strategic issues after their bold decision to support, genocide. The boycott calls have been loud and clear across social media. Millions of posts, memes, and angry tweets. But according to Starbucks CEO and board, that's not it. They are convinced it's all about the strategy. Yeah, sure, that's why sales are tanking. Nothing to do with, I don't know. It's just a menu adjustment should fix it. So the next time you're considering a trip to Starbucks, remember it's not just the long line and complicated menu that might keep you away. Thank you for watching Market Pulse Weekly. Stay tuned for updates.